Welcome to the Deep Dive, where we cut through the noise and really delve into the insights that matter, all tailored just for you.
That's right.
Today, we're dissecting something pretty interesting, how a banking giant like Scotiabank is tackling a significant transformation.
Mm-hmm.
They seem to be moving away from just chasing loan volume, the traditional way.
Right, more towards strategically cultivating value and deeper client relationships.
Exactly. So our mission today is to cut through the numbers, the jargon, and help you understand not just what happened in their Q3 2025 earnings,
But why it matters, why these strategic shifts are important for their long-term health and maybe the broader financial landscape too.
So where do we get this info?
Well, we've got a pretty robust set of sources to guide us. There's a detailed earnings call featuring their top executives.
Okay.
And also a comprehensive investor presentation. So it gives us a rare window, really, into how a global bank like this navigates the current economic conditions.
And makes these big strategic pivots.
Exactly, and how they balance, their diverse international markets with their home base here in Canada.
Should be some surprising insights in there, I bet.
I think so. Especially seeing how these intentional choices play out in the real-world results.
Okay, let's unpack this then. Let's get right into the headline figures Scotiabank reported for Q3 2025.
Let's do it.
They delivered adjusted earnings of $2.5 billion. That translates to 1.88 per share.
Okay, $2.5 billion, and that's up 15% year over year, right?
That's right, a 15% jump, and their pre-tax, pre-provision earnings also up significantly by 17%.
Wow, 17%. And maybe we should quickly explain that pre-tax, pre-provision bit for everyone.
Good idea.
It's basically the bank's profit before they account for taxes or set aside money for potential bad loans, the provisions.
So a 17% jump there really signals strong operational health.
It really does. And the ROE, return on equity.
That reached 12.4%,
Uh,
and that's up a strong 110 basis points from last year.
Right, so 1.1%. Basis points are just hundredths of a percent. So 110 is quite a healthy increase in ROE.
These are certainly robust financial outcomes on the surface.
Yeah, and what this tells us, I think, is that these strong numbers aren't just, good news on paper.
Right.
They really signal a crucial success in Scotiabank's pivot, that move from sheer volume to more targeted value.
It shows that re-engineering of the balance sheet is starting to pay off.
It seems so, yeah.
Yeah.
Generating more profit from their existing capital.
Yeah.
Which is, it's a massive win in today's interest rate environment.
And a clear sign of progress toward those Investor Day commitments they made.
Absolutely.
That value over volume strategy, it really feels like the key thread running through their whole report, doesn't it?
It does. They've been actively repositioning their balance sheet for, the last 24 months now?
Yeah, about 2 years. Focusing on cross-selling to existing clients and right-sizing, optimizing their lending relationships.
So that means lower overall loan growth compared to maybe what we've seen historically from them.
Right, which might seem a bit counterintuitive for a bank at first glance, but it seems to have significantly improved their ROE, boosted their capital capacity, and enhanced their liquidity.
And those improvements are directly fueling their share buyback program, which investors usually like to see.
Definitely. And now, looking ahead, they're anticipating increased profitable loan growth next year.
But only in very specific, targeted areas, right? Not just growth for growth's sake.
Exactly. Quality over quantity seems to be the mantra.
Yeah, the implications of this balance sheet optimization are pretty crucial. While loan growth is, traditionally a primary indicator for banks.
The main thing people look at often.
Right. Scotiabank is clearly prioritizing the quality and the profitability of those loans, not just the sheer number.
It's a strategic shift, like saying, we'd rather lend less, but earn more efficiently from each dollar we lend.
Precisely. Which brings up a good question for us, I think. How does this focus on efficiency and cultivating these deeper client relationships actually translate into tangible results, across their different business segments?
Yeah, that's the key question. Perfect segue. Let's start at home here in Canada.
Okay. Canadian banking.
Average loans were up 3% year over year. Mortgages led the way, up 5%. Credit cards up a bit, 1%.
Okay. Moderate growth overall there. And deposits.
Deposits also grew, 2%, mostly in checking and savings accounts.
Got it.
Now, interestingly, while their reported net income was slightly down 2% year over year, their pre-tax, pre-provision profit was actually in line with last year, but showed a strong 7% increase just quarter over quarter.
So the underlying operational performance seems strong, even if the bottom line dips slightly year over year, maybe due to higher provisions last year or something?
Could be. And one of their big successes here, a really clear example of this strategy in action, is their Mortgage Plus solution.
Ah, yes, Mortgage Plus. Tell us about that.
Well, this offering, it accounted for roughly 90% of all their new mortgage originations year to date,
90%. Wow.
even including mortgages coming through the independent broker channel.
That's impressive penetration.
And what's more, they said 95% of those new clients kept their day-to-day bank accounts with Scotiabank after a year.
Oh, okay, so it's sticky.
Very sticky. And 30% of them also opened a credit card, typically with higher average balances than other clients.
So that really speaks to the concept of primacy, doesn't it? Being the main bank for a client.
Exactly.
Mortgage Plus seems like a textbook example of driving those multi-product relationships, not just a one-off mortgage transaction.
They're using the mortgage as the hook,
Yeah.
the entry point for a deeper relationship.
Right. And this focus is apparently fostering strong cooperation between Canadian banking and their global wealth management division, too.
Yeah, they mentioned combined referrals between retail, commercial, and wealth were up 13% year over year.
To $11 billion. That's a significant flow.
It really is. It highlights how they're not just selling products anymore, but really building these sticky, long-term customer relationships.
Which are inherently more valuable to the bank over time, right? Less churn, more cross-selling opportunities.
Makes sense. So that client primacy strategy seems to be thriving in Canada. Does that focus extend into their global wealth management segment? And are they seeing similar success there, maybe internationally too?
Oh, absolutely. Global wealth management is kind of seen as the glue holding that client primacy strategy together.
The glue, okay.
It connects clients to a broader suite of services, beyond just traditional banking accounts.
Gotcha.
And the numbers look good. Earnings in this segment were up a very healthy 13% year over year.
13%, nice.
And internationally, even more impressive, international wealth management earnings jumped 21%.
21, wow.
Yeah, with 18% asset growth just in Mexico alone.
Mexico seems to be a key area for them.
It does. And we also saw net sales in their collective wealth channel, think mutual funds, ETFs, show an $11.2 billion improvement compared to last year when they had net redemptions.
That's a massive swing from outflows to inflows.
Huge turnaround. Plus, their private bank is seeing double-digit loan and deposit growth. And Scotiabank, their full-service brokerage, all-time high fee-based assets.
So strong momentum across the board in wealth.
It seems so, both in Canadian wealth advisory and retail investment advice. Year-to-date net sales are trending positively at $1.7 billion. It really points to successful cross-selling, deepening those client relationships beyond just basic accounts.
Clients are trusting them with more of their financial lives, essentially.
That's the goal, right?
And it's not just about traditional banking relationships either. They're also investing pretty heavily in productivity initiatives, especially AI, artificial intelligence.
Right, the tech angle. What are they doing there?
Well, they completed the rollout of their Ask AI internal chatbot. This is for employees in all Canadian bank retail branches and client experience centers.
So helping the staff help the customers.
Exactly. Designed to assist frontline employees with inquiries, make them more efficient, find answers faster.
Makes sense. Less time searching, more time advising.
And their external AI chatbot, the one customers interact with, that's handling over 125,000 inquiries every month.
That's a huge volume of automated support, clearly integrating tech into the core operations.
Definitely a sign of the times in banking.
For sure.
Now, let's shift our focus globally, starting with international banking.
Okay, beyond Canada and wealth.
Yeah, this segment is actually trending ahead of their Investor Day commitments, which is good news for them.
I had a plan, always nice to hear.
They reported a Q3 return on equity, ROE, of 15%. That's up 180 basis points, or 1.8% year over year.
15% ROE internationally is quite strong.
And revenue was up 3% year over year on a constant dollar basis, so stripping out currency fluctuations.
Okay.
And they managed disciplined expense control, too, keeping expenses flat despite, all the inflationary pressures everywhere.
That is a tough balancing act. Holding costs flat when inflation is pushing everything up, that takes effort.
It really does. Their regionalization strategy seems to be key here.
Can you unpack that a bit? Regionalization.
It sounds like an intentional effort to improve customer experience, boost revenue, and lower costs by focusing on specific high-potential markets rather than trying to be everything to everyone everywhere.
Right. Concentrating their firepower.
Exactly. And we're seeing a definite pivot to growth in international banking now, especially as their client deselection program in the commercial space is largely done.
Ah, so they finished pruning the less profitable relationships.
Seems like it. And now they're focusing on targeted growth, particularly in the affluent and emerging affluent segments in countries like Mexico again.
There's Mexico again.
Yeah.
Clearly a strategic priority.
Yeah. What this really highlights, I think, is how they're meticulously refining that international footprint. They're prioritizing wallet share and higher returns over just sheer volume.
Especially maybe in some markets where they'd previously seen weaknesses in the commercial portfolio, as you mentioned.
Right. Sharpening the focus.
So this regionalization is making international banking more efficient, more focused. What about the high stakes world of global banking and markets, GBM? Are we seeing similar discipline there?
That's the big question, isn't it?
Ye-
Especially with the shifts they're making and where the revenue comes from.
We are indeed seeing it there too. GBM delivered another very strong quarter, earnings up a remarkable 29% year over year.
29%. That's huge for GPM.
And revenue increased by 21%. Now, what's really interesting here, connecting back to that theme.
Value over volume.
Exactly. Loans actually decreased by 14% year over year in GBM.
It's increased. Okay.
But the pre-tax, pre-provision earnings jumped by 29%, and ROE was up by a robust 310 basis points.
So higher profits and returns on less lending. How did they manage that?
Largely due to a significant increase in non-interest revenue, so money made from things other than just lending.
Like fees.
Right, including a strong 28% year-to-date growth in underwriting and advisory fees, so helping companies with M&A, raising capital, that sort of thing.
Okay, that makes sense. Higher margin business.
And plus, they saw very robust trading-related revenues. Those are up a substantial 50% year-to-date.
50%. Wow. Trading has been good for them.
Very good. So if I'm getting this right, they're consciously shrinking their loan book in GBM,
Yeah.
but generating much more profitable revenue from other sources like advisory work and trading.
Precisely. It's a move towards capital velocity, getting more bang for their buck, and focusing on those higher margin activities.
And GBM's strong performance is notable, especially the U.S. contribution. The U.S. brought in 42% of GBM earnings in Q3.
42% from the U.S. underscores the importance of their North American strategy.
Absolutely. And they also launched a pilot of a modern U.S. cash management offering. That's a key step in strengthening their U.S. footprint and, again, achieving that primacy with commercial and institutional clients stateside.
Building a more durable franchise, aiming for more than normal results in trading, as they put it, rather than just relying on basic lending.
Yeah, it raises an interesting question, maybe for you, the listener. How does this shift towards fee-based income and more active capital management in GBM impact the bank's overall risk profile and its future growth potential? It suggests a different kind of balance, doesn't it?
It really does. Okay, let's talk about their financial bedrock, their capital position.
Right, the safety net.
Scotiabank ended the quarter with a strong Common Equity Tier 1 ratio, CET1. It was 13.3%.
13.3. And that was up quarter over quarter.
Yep, up 10 basis points, driven by internal capital generation, basically, profits they retained.
And just to remind everyone that CET1 ratio is a critical measure of a bank's core financial strength. Shows how much high-quality capital they have to absorb unexpected losses.
Exactly. So at 13.3%, they're comfortably above the regulatory requirements. Gives them a solid cushion.
A lot of buffer for growth or, any unforeseen economic bumps.
And they also use some of that capital to repurchase shares. 3.2 million shares under their NCIB program.
That normal course issuer bid, how much capital did that use?
About 5 basis points, they said. Relatively small compared to the generation.
So this really strong capital position, it acts like Scotiabank's robust financial safety net, right? Gives them huge flexibility.
Flexibility for downturns or for jumping on growth opportunities.
And their priorities for using that capital seem pretty clear. Growth first, then managing credit migration, then buybacks.
Right. So if I'm hearing you right, they're essentially saying, our top priority for this extra cash is to invest it to grow the business. Second, we'll use it to shore up against any potential loan losses.
Right. Managing risk.
And only after those two are covered, then we'll return capital to shareholders through buybacks. Is that about right?
Yeah, that sounds like the hierarchy. It really lays out their priorities for financial health. And they're comfortably above that 13% CET1 mark, aiming for consistent internal capital generation, 15 to 20 basis points per quarter?
Yeah, through 2026 and maybe into 2027.
A strong foundation.
Okay, moving to credit quality. It looks like it's improving, which is definitely good news in this kind of environment.
Always a relief to see.
All bank provisions for credit losses PCLs, that's the money set aside for loans expected to go bad, were about $1 billion, or 55 basis
And
points.
that was down compared to the previous quarter.
Yeah, down 20 basis points quarter over quarter. Performing provisions for loans, still okay, but maybe riskier, were down to just 4 basis points after being higher in Q2.
Okay.
And impaired provisions for loans already sour were also lower, particularly in Canadian retail and GBM.
So broadly positive trends on the credit front. But the devil's often in the details with credit, isn't it?
Always.
And it seems they're monitoring these micro trends very carefully, balancing, cautious optimism with proactive risk management.
For instance.
Well, in Canadian retail, they saw improvements in auto loans and unsecured lines of credit. They mentioned that phrase, the pig moving through the pipeline for the 2022 and 2023 auto loan vintages.
Huh. Yeah, I saw that. What does that actually mean, the pig in the pipeline?
It's a classic industry phrase. It essentially means that the initial wave of loan defaults they anticipated from loans made in those specific years, 2022 and 2023, has now mostly passed through their system.
Ah, so they've kind of absorbed the expected hit from those earlier, maybe riskier loans.
Exactly. They've accounted for the financial impact. It's a sign they've weathered that specific bump. However,
There's always a however with credit.
isn't there just 90-day plus mortgage delinquency held steady at 24 basis points overall?
Okay, steady.
But within that, there was a divergence. Improvements among variable rate mortgage clients were offset by rising delinquencies among fixed rate clients.
Ah, as they renew their mortgages at potentially much higher rates.
Precisely. Those fixed rate holders are facing payment shock at renewal. It's a really critical nuance, isn't it?
It shows how different parts of the mortgage market react differently to interest rates. Not a simple story.
Not at all. So they remain cautious, they said, due to sort of mixed signals on Canadian consumer health, especially among younger adults, 18 to 26-year-olds.
And ongoing trade uncertainty doesn't help either?
Nope. Internationally, PCLs were stable overall, but loan loss formations did increase in international commercial, particularly in Mexico again. So that's an area they're definitely watching closely.
Okay, so a complex credit picture, improving overall, but with specific pockets of concern they're managing.
Sounds about right.
Let's quickly round out the financials with net interest margin, NIM. That's the spread between what they earn on loans and pay on deposits.
Key profitability driver.
The all-bank NIM expanded a strong 22 basis points year over year and 5 basis points just quarter over quarter.
22 basis points year over year is a good expansion. What drove that?
Mainly lower funding costs and higher margins in the business lines themselves.
Okay.
Canadian banking NIM was up 2 basis points quarter over quarter, helped by an improved deposit mix.
Getting more lower cost deposits like checking accounts.
Seems like it. And international banking NIM expanded 13 basis points year over year, mainly from lower funding costs there too, and some opportunistic trades they mentioned in Brazil.
Interesting. So NIM is holding up well, expanding even.
Which brings us neatly to the broader environment they operate in, the macro picture.
Right, the backdrop for all this strategy. GDP forecasts show a pretty complex landscape globally.
Yeah, Mexico, for instance, is projected to actually see GDP contract in Q2 and Q3 of 2025.
A contraction that could certainly impact loan demand and credit quality there.
Definitely. And it's vital to consider political factors too, right? Things like the judicial branch elections coming up in Mexico in 2025.
And general elections in Chile in November 2025.
Yeah, those kinds of events can inject market uncertainty, impact economic stability.
Which raises, I think, another important question for you, the listener. How do these shifting global economic and political landscapes influence a bank's ability to stay on its strategic path, especially when they're trying this big pivot towards value and deeper client relationships?
It adds another layer of complexity they have to navigate. So, wrapping this up, what does this all mean for you, someone trying to stay informed about the financial world?
Well, it means Scotiabank is actively transforming. That seems clear.
Yeah, they're definitely moving from that defined optimization phase, focusing hard on efficiency, balance sheet quality, into a more targeted growth phase now.
And this whole shift seems underpinned by that strong capital position we talked about and a really keen eye on efficiency and client primacy right across all their different business lines.
So, summing up the shifts.
I'd say first, that move from valuing sheer volume to prioritizing value in lending. Second, shifting from a very broad international presence to a more regionalized, higher return focus.
Right.
And third, really embracing digital innovation, like that AI stuff, and pushing cross-selling hard to deepen those client relationships.
The journey of a global bank like this, it really is a fascinating interplay, isn't it? Between huge global macro trends, their own internal strategic choices.
And the everyday experiences of millions of clients they serve, it all connects.
And here's where it gets really interesting for me. Thinking ahead, we talked about Scotiabank's Ask AI chatbot, that internal tool for employees. As banks continue to navigate this world of, rapid technological change, shifting consumer behavior, ongoing economic uncertainty, how do you think their reliance on AI, both internal, like Ask AI, and external customer-facing bots, how will that reshape the frontline banking experience?
And what does it mean for client trust in their financial institutions over, say, the next 5 years?
Yeah, it's a profound question, really, about the future of human interaction in banking. Something to think about.
Definitely food for thought.
Thank you for joining us on this deep dive.